Friday, July 3rd. Here's what today's story could mean for the Korean market.
Welcome to today's deep dive into the Seoul Economic Daily Reports. We are tracking a massive collision between, institutional capital and these structural market traps. So if you're trading the KOSPI or navigating ETFs right now, our mission today is to decode three brisk, data-dense realities reshaping the board.
Yeah, the tension under the surface is just remarkable right now. You have major players forced to sell, retail traders trying to time the volatility, and regulators inadvertently squeezing professional funds.
Right. So let's look at that institutional squeeze first. I mean, in June, the daily average turnover for inverse ETFs, it spiked 48% from May, hitting 2.81 trillion KRW, which is roughly 2 billion USD. That is a massive bearish bet.
It really is, and it's driven by a very specific July risk, the National Pension Fund. Their temporary exemption for domestic equity rebalancing just expired. So this mechanically triggers forced selling pressure on KOSPI large caps, and traders piling into inverse ETFs basically saw that institutional wave coming. But retail traders took the exact opposite side, right? And they used leverage to do it. On July 1st, retail scooped up 511 billion KRW, so about 365 million USD, in leveraged single-stock ETFs for Samsung and SK Hynix. Then the very next trading session, those products plunged anywhere from 19 to 30%.
Yeah, that is a brutal swing.
Exactly. Okay, let's unpack this. Playing with single-stock ETF leverage is like driving a sports car with no brakes. It amplifies the structural decay, not just your directional conviction.
That is actually the perfect way to visualize it, because when a leveraged fund drops, say 10% one day, it requires more than a 10% gain the next day just to mathematically break even. So in a choppy market, that daily rebalancing math rapidly eats your capital. The leverage amplifies the decay, not just the bet.
Wow, so retail traders are just getting chewed up by the math. But professional fund managers are currently trapped in a bizarre waiting game of their own with regulators.
They are, yeah. The regulatory mechanics here are catching a lot of managers completely off guard. 6 active ETFs just failed Korea's zero point 0.7 correlation coefficient threshold, and 4 of them are formally delisting between July 7th and 9th.
Wait, explain that threshold. If it's an active ETF, shouldn't the manager be actively deviating from the index to find alpha? Why are they forced to correlate?
Well, that's the quirk of this specific Korean rule. These active funds are legally required to maintain a 70% statistical similarity to their benchmark index, calculated over a rolling one-year window. Now, regulators had actually promised to eliminate this restriction by the second half of 2026.
Oh, I see. So some forward-looking managers proactively adjusted their portfolios to be truly active.
Exactly. They assumed the rule would be gone.
Wait, if the rule was supposed to vanish anyway, aren't regulators just punishing managers for adapting early?
Basically, yes. What's fascinating here is the unintended consequence of delayed deregulation causing forced liquidations. The reform got pushed back to Q2 2027 at the earliest. Because that compliance metric uses a 12-month look-back period, the managers who shifted their strategies early are now mathematically locked in a one-year rolling compliance gap.
So even if they rebalance today, they can't fix their one-year average fast enough to avoid delisting. It's a total regulatory trap.
Exactly.
Well, while those active funds face forced liquidations, the KOSPI's heaviest weights have the exact opposite problem, overflowing cash reserves.
Yeah, SK Hynix is the prime example of this right now. They are riding a massive semiconductor supercycle, and they just deployed 250 billion KRW, roughly 175 million USD, into AA rated corporate bonds.
Which is incredible when you look at the sheer scale of their projections. Their Q2 operating profit consensus is sitting at 63.9 trillion KRW, or about 45 billion USD. That is up 7 times year on year. And this marks their first ever entry into the public bond demand process. Here's where it gets really interesting, is this semiconductor giant generating so much cash, they're effectively forced to act like an institutional bank.
Honestly, the velocity of their cash flow absolutely demands it. They have completely outgrown standard corporate cash management strategies and are now stepping directly into the credit markets as a major institutional buyer. It alters how liquidity flows through the domestic financial ecosystem.
June saw a 48% surge in inverse ETF daily turnover, signaling deep market caution. The risks defining today's session hinge on the National Pension Fund's forced selling of large caps and the unpredictable fallout of active ETF delistings. However, SK Hynix's unprecedented bond buying shows that semiconductor wealth is now directly stabilizing domestic credit markets alongside equities.
Just a quick reminder to you listening, we are strictly analyzing market data today, and absolutely no financial advice is being given. #KOSPI.
Always important to note. And it leaves you with something to really think about. If tech giants continue generating cash at this velocity, how might corporate mega profits permanently rewrite the traditional roles of institutional bond buyers?